Hello, everyone. We will be starting our Q1 briefing session in a few moments. While we give our audience a chance to tune in, let me share a few operational notes. We hope to make this an interactive session today, so feel free to send in questions throughout the presentation. Use the Q&A chat function and we will address them later in the program. Please note that this event will be recorded, including the phone, ringing in the back. Finally, I want to thank our anchor signers, Arbella Insurance Group, Mass General Brigham, Mass Mutual, Putnam Investments, State Street, Red Hat, and Vertex Pharmaceuticals for their continued generous support, which allows us to bring you programs like the one today. So let us begin. Welcome, Compact Signers, to our Q1 briefing session for 2023. I am Kim Borman, Executive Director of the Boston Women's Workforce Council. Many of you joined us at our Effective Practices Conference in December, where we had the pleasure of hearing from Lee Pelton, President of the Boston Foundation, who spoke to us about the connection between the gender wage gap and wealth gap. One of the takeaways from Lee's remarks was closing these gaps takes understanding the difference between equality and equity. As Lee put it, equality means each individual or group of people is given the same resources or opportunities. Equity recognizes that each person has different circumstances and therefore allocates the exact resources and opportunities needed to reach an equal outcome. Today, we'd like to follow up on that concept of equity and how it can be addressed through smart and careful decisions by women in their approach to investing. Our speaker today is Sallie Krawcheck, who has made it her mission to make sure all women, no matter their background or economic circumstances, understand that they can control their financial future. Some of you may know Sallie by reputation. Investment Advisor magazine called her one of the most influential women in finance. The Daily Beast said she's one of the rare, honest voices on Wall Street. She has held CEO positions at Merrill Lynch, Smith Barney, U.S. Trust, and Citi Private Bank. In 2014, Sallie founded Ellevest, a financial company built by women for women who tend to have different career paths and often lower salaries than their male colleagues due to gender wage gaps. She and her team have grown the company to $1.5 billion in assets under management by building equity into their investing strategies. Understanding again, as Lee Pelton explained, each person has different circumstances and therefore may need different resources to reach the same outcome. In this case, reaching financial well-being is the outcome that lets women build and live the life they want. Facilitating the conversation today will be our council member, Victoria Budson, partner and global head of diversity, equity, inclusion at Bain Capital. Prior to joining Bain Capital, Victoria spent over 20 years at the Harvard Kennedy School, where she was the co-founder and executive director of the Women in Public Policy program. We are grateful to have her on our council and especially appreciative for her willingness to moderate our event today. With that, let me turn it over to Sallie.
Oh, thank you. Thank you for having me, for hosting me, and for being so persistent in reaching out and getting me here. I'm so happy to be here with all of you today to talk about pretty much my favorite topic, which is women and money. Thank you for mentioning Ellevest. Ellevest we are building a company that are the expert in women's wealth. And you mentioned that Ellevest is built by women for women. I would take a further step back and say that Ellevest is funded by, founded by, built for, and investing in women. We began as a digital advisor, a robo-advisor, focused on women, not as a marketing campaign or an email list, but as a company that stripped the offering down to its very core, recognizing that women earn differently, take more career breaks, their salaries peak sooner, and we live longer. And so recognizing that therefore we should invest differently as a result of it, and that we have different needs, different circumstances that are not being fully, were not being fully met by the industry. So I'll go into that a little bit more in a bit. But it's certainly our mission and the reason each of us gets out of bed in the morning with a goal of building women's wealth. Our view is, if we were together, I would say raise your hands high if you can think of anything bad that happens when women have more money. Nobody's hands would go up. Sometimes, occasionally, someone will raise their hand and say they spend more, which of course means the economy grows. So that's a good thing. The last time I spoke to a group, someone raised their hand and said, it makes men feel uncomfortable. I guess that's a downside to it. But one where I think the economic growth we can see from having more wealth in the hands of women, the fact that when women have more wealth and those wealth gaps close, we have fairer societies. The fact that it could mean the markets operate more efficiently, the fact that our kids are better off, whether that's our daughters we certainly think of, but our sons, our spouses, our partners, small businesses are better off. And in fact, nonprofits are better off because women, when they have wealth, tend to give a larger percent away. In fact, I would also argue that the politics get less angry. I don't know that is any coincidence today that women have 30 cents of wealth for every dollar that men have, and women tend to give about that 25 to 35 cents of political contributions for every dollar that men give. And so across a range of things, we know the research in developing economies that women will put 90+% of their earnings back into their family and community, men much less. The same thing is true in developed economies as well. And so our mission at Ellevest is to make the world better by helping women grow their wealth. The other thing I would say is that today, money is women's number one source of stress. And that the way to make it better, she's losing, by the way, for some women days, for other women weeks, of presenteeism in her job because of worry about money. The very direct way of making that better is for women to take action around their money. And when they do, when they're on that path, maybe not have reached financial wellness, but to be on the road to financial wellness, that reduces the stress and gives her, and is in fact the number one driver, her confidence in her ability to achieve her future goals. I would say things out there in the United States for women today, it's sort of rough. I know it feels like it should be 2 steps forward and then 2 more steps forward and 2 other steps forward. It has been 2 steps forward and in some cases 3 steps back. At Ellevest, we wanted to measure women's financial wellness, and so could not find a quantitative measure of it. And so we pulled together the Ellevest Women's Financial Health Index, which has a range of inputs into it, such as women's employment rate. The gender pay gap is one example. Inflation, it hurts everyone. Inflation hurts women of color, people of color more because they have less in terms of assets. And I could, the reproductive rights. That is, of course, a social issue. It's a political issue. It's a religious issue. It's an economic issue. And when women's reproductive rights are under attack and being rolled back, that has a negative impact on our economy. And so we pulled together about, I think it's 15 or so inputs for the Ellevest Women's Financial Health Index, and determined that the pandemic was tough. This environment has been even tougher. And that with the attack on reproductive rights, with inflation, with women getting back into the workforce, and it's picking up some steam, but wasn't as quickly as it could have been, with the gender pay gap having stalled out, that women have been in an even tougher position over in, right now than they were over, say, the past 5 years. So it's a little bit rough and tough out there right now, which doesn't at all take away the importance of getting more money to women. I always say money may not buy happiness, but it does buy you the ability to leave a relationship that no longer works for you, leave a job that is unbelievably boring or potentially toxic. It gives you the opportunity to start the business you've been wanting to take the trip that you've been wanting to live a fuller life and to reduce stress. And so that's why our mission is to get more money in the hands of women. Now, it's pretty straightforward how to do this. I'm not saying it's easy, but it is in fact pretty straightforward. There have really been two ways to build wealth in this country historically. It hasn't been through crypto. It hasn't been through on any type of scale or with any type of reliability, starting, Amazon or starting a Microsoft. Those have been ways that people have built wealth, but they are individual, they are not scalable, and they are not repeatable. In order to build wealth in this country, it's not your job. Your job, the money can come in, the money can go out. The money can come in, the money can go out. In order to build wealth, you have to tap into the power of compounding. You have to begin with some amount, and then you earn returns on that amount, and then you earn returns on the returns, and returns on the returns on the returns, and returns on the returns on the you get the point. And I'm sure, given that so many of you are in financial services, you know the chart that shows simple interest, and you know the chart that says compound interest. And where the singular genius of Warren Buffett is, not that he isn't a genius in most things, but is recognizing the power of compounding and the power of time in which capital gets put to work. So there have been two ways to do this that have been somewhat accessible and repeatable. One is to buy a home. And if you buy a home, it's good. The house prices have gone up about, 3% a year historically, sometimes more, sometimes less, different parts of the country, different ways, but it's been about 3% annually. And the issue with buying a home is, number one, you've had to put down some amount of capital. No, so that's not accessible. Number two, you have to take on debt in the form of a mortgage. And we can all debate about what percent of the returns that our grandparents got was the impact of leverage and was the impact of the underlying asset, but we'll leave that for the time being. And then of course, because of redlining, there have been large groups of our population who have not had buying a home accessible to us, but there are people on the phone I know who remember their grandparents. You can't believe it. We bought this little thing in the 19 blah, 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 and we fixed it up and we took out the mortgage and we finally paid the mortgage and it's worth all this amount. So that has been a way to build wealth. The other way to build wealth has been to invest. And that today is accessible through a company like Ellevest, where there's no investing minimum. You can buy fractional shares, you can invest in small amounts of ETFs. You've not had to take on leverage in order to do it. And by the way, I should have mentioned this too, it's liquid. You might not like the price you get for a stock on the NASDAQ or New York Stock Exchange on a Tuesday afternoon, but you can get a price typically for that stock. And if you can't, across the market, we have much, much bigger issues, whereas of course a home can be illiquid. And so what Ellevest identified, some years ago was, yes, we're all talking about the gender pay gap. And there are zillions of, if you Google it, there's zillions of reports on it, articles on it, et cetera. Very few people talking about the gender wealth gap at the time, even though it is worse, the gap is worse than the pay gap and going in the wrong direction. And very few people talking about the gender investing. And the fact one of the components of that wealth gap is that women have not invested as much as men have. And if we could build a company around that, we could help women build that wealth in an accessible way. P.S. just talked about the power of compounding and how that's been driving, for people who've got capital, the increase in the wealth gap. Well, we have to also acknowledge for people with less, in terms of economic resources, that the power of compounding can hurt them as much as it's helping people with capital. And that, of course, I'm talking about credit card rates, which as of a few weeks ago, I haven't checked the number recently with interest rates going up. Credit card rates, I was reading somewhere, are the highest they've ever been. Seems a little surprising to me, but average credit card rates are certainly quite high. And I know many folks on the call have experienced that. When you buy something, you put on the credit card, you pay the minimum, and you come back the next month and you owe even more. And then you pay the minimum, and the next month you owe even more and you owe even more. So what's been happening as the pay gap for women has gradually been getting better, not nearly fast enough. It feels like it's been a snail's pace, during the pandemic and coming out of it. The wealth gap has been opening up as the rich have gotten richer, and the folks who have had less resources have had the negative impact of compounding. So let's back up a step, because what are the things that get in the way of women building wealth? Well, one of them is you do have to have some money to make money. And for women who are living paycheck to paycheck, for women who begin to bring home that first paycheck, and particularly in our communities of color, are expected and want to and do support broader families than white women are expected to and that do. Those are issues, we go through a range of issues for what keep women from building wealth. One that we identified, which is one of many, is that the industry was not built for them. That when I worked in the traditional Wall Street and investing firms, there would be women's initiatives that were launched. It would typically, I love to joke that we go through the strategic planning sessions, and someone would say, women there are a lot of them. They have a lot of money. They're graduating college at a greater rate than men are. They're the majority of college graduates, and even greater majority of master's graduates. They're entering the workforce, that's a big market. They would typically put out a women's initiative. It would involve marketing to women. It would involve newsletters. They would fail to take off in any meaningful way. And what you would hear the next year or the year after is, well, we tried that, but women are risk averse. And it's clear because they are not investing with us, and we had an initiative and they didn't respond to it. Or women aren't particularly good with math. Or women need more financial education. Or they don't like doing it, or they're not good at it. And again, evidence, they're not buying what we're selling. They're not reading Barron's. They're not watching as much CNBC. They're not as involved. Therefore, there's something about the estrogen that is keeping women from investing. And it's not our fault, it's them. And we need to, they haven't changed enough. Ellevest was really the first that said, maybe that's not the issue. Maybe the fact that women aren't using the capabilities that the investing industry is providing for it as much as men are is not because women are risk averse. Maybe they're not buying what we're selling. Maybe in an industry where 98% of mutual fund dollars are managed by men, even though the research shows you that women are better investors than men, outperforming whether it's hedge fund investors, mutual fund investors, individual investors by a percentage point or so a year, trading less action around it, making choices and leaving them to sort of play through. But 98% of mutual fund dollars are managed by men. And I've read somewhere that 99% of investment dollars are managed at companies owned by men. 86%, 85, 90% of financial advisors are men, 90+% of traders are men. Maybe fintech, by the way, where the innovation is happening, the majority of venture dollars are raised by men. In fact, having just raised our Series B at Ellevest last year, women raised 1 in 10,000 Series B fintech venture dollars, and it felt like every bit of that. Maybe these businesses then were built not on purpose. Nobody meant it. It wasn't supposed to be that way. But maybe they built these businesses centered on men, and that much like, as we all know, in the medical field, so much of the research, medical research, was done on men, and then just like, yeah, it's good enough for the gals. In the car crash industry, the car crash dummies were centered on men, built as men, and therefore women have died at a higher rate. Maybe the industry built a business for itself. Nobody meant to, nobody's fault. But it was more centered on trading, on what went into it, as opposed to what we found when we were doing research on Ellevest, is that women, not all of them, everybody's different, it's a kaleidoscope of personalities, but if we had to generalize, women were more goals-based, more impact-oriented, less interested in the bottoms up of the large cap value mutual fund or the buy IBM and sell Amazon. That they really were more about picturing, visualizing what they want to achieve and accomplish, and investing as a means to an end, as opposed to investing as something they were particularly interested in doing amongst everything else on their plate for its own sake. So Ellevest began to build from the bottoms up based on thousands of hours of research with women of what would engage them and interest them in investing. So we at Ellevest talk about that, this view that women are risk averse, that they're not good with money, that has been projected onto them as one of the great lies, one of the great money lies that we've been told. If I were to get a little feminist with a capital F here, and invoke Gloria Steinem, we talk about how some of the great unfinished business of the feminist movement of the 70s was not focusing enough on building wealth. That group at that time who led those movements were from the left, viewing building wealth was not a priority for them. And so therefore they didn't have as much attention to it. At the same time, in a patriarchal society, we received messages as young girls and into young adulthood and into more mature adulthood, that we weren't good with money, that it was sort of cute and fun to be not that good with money, sort of feminine, attractive. In my day, you were a cheerleader, you didn't play volleyball, and you just weren't good with money. And unfortunately, some of that you can see even in the Gen Z and millennial women, of the sort of, I don't want to have to deal with that. Something today, the vast majority of media articles, videos, etc., talking to men about money are positive. And I can't remember the stats, but it's something like 90% are about abundance and growth and making money and moving ahead and good stuff. Whereas the flip side, the vast majority of articles and media to women about money are about scarcity. And a lot about not just how she's risk averse and not good with money, but that she's a spendthrift, and that it's about scarcity. And she's, it's about budgeting, it's about coupon clipping, it's a flibbergidget. You're buying too many shoes. You're, Sarah Jessica Parker on, bought so many shoes in Sex and the City that she couldn't afford her apartment, all of her fault. And so we take, peak, if I could use the word misogyny, is pumpkin spice latte. All the articles about don't buy the latte, invest the money instead. And that's somehow going to get you through to retirement. And the disdain that we as a society sort of heap upon the mostly women who go after the pumpkin spice latte in the fall, as if not enjoying that little treat is going to make all the difference. These articles don't say, you know what, honestly, have the pumpkin spice latte. The real problem over here is that you are earning 80 cents to a white man's dollar. The real problem is that you've been so talked to negatively about money that you don't think you're any good at it. And so that's the great money lie. And in a patriarchal society where men are viewed as being better with money, they go into Wall Street, they go into investing, they go into venture. Women tend to go to those industries at a lesser rate, and when they do, they have not made it to the top as quickly or as seamlessly as men have. And so that great money lie of you're not good with money is a sort of tough one that we at Ellevest really work to try to sort of dig out of the wasteland there. So let me sort of pause there for a moment. We could talk about the other money lies that women are told. One of them on the career side, we think about a lot, where there's so much career advice for women about how to get ahead. And typically it boils down to you're on your own, and here's your checklist, and here are the slogans, and here are the books that you should read, and away you go. And we tend to play that sport as an individual sport when we're each of us trying to make it for that 1 or 2, maybe now 3 seats at the senior table. Whereas the men in our lives are playing the game as a team sport and recognize that some number of them can make it to the table, and they promote each other, talk each other up, put each other on the boards, hire each other's kids, et cetera. And we have received sort of instruction, in the Barnes and Noble aisle about how each of us is on our own, and each of us needs to find that mentor, find that sponsor, and somehow navigate the treacherous waters that have not always been as accessible to us to get to the top. So those are a few of the money lies, but let me pause there and see if what I've talked about has provoked any thoughts, reactions, or questions.
Sallie, thank you so much for joining us today and really giving us a whole step-by-step new way of thinking about women and investing. For our listeners who they themselves or women in their life are really at that stage where maybe they've been able to save something. Maybe for some women, it's several $100s a month. Maybe for some women, it's $50 a month. But talk to us about, and maybe they're doing just what you described, which it's savings and not investing. So they're missing out on that wonderful compounded interest. What should someone do when they get home tonight and they set aside 45 minutes to now action what they've learned from you? What are the key next steps they should take?
Yeah. So I love this. So first of all, if the money is in savings, you're moving backwards every day, particularly now that we've got a bit of inflation in the environment. Historically, you put that money in the bank account, it feels good, but it's worth less tomorrow than it was today, and worth less the day after and the day after. So it simply hasn't been good enough. Whereas investing, and I apologize that I didn't share this, and a lot of you on the call know this, talked about real estate going up, call it 3% a year. The stock market, if you look back through to the 1920s, I think the rate of increase annually has been, call it 9.4, 9.5%. I think before last year was 9.7%. And then with the market being sort of tough last year, it pulled back down with volatility along the way. But had you invested on any day in the S&P 500, call it, and left the money there for 20 years. So it could have been a good day, it could have been a bad day, it could have been the day before the crash of 87, it could have been, the day before we all found out about it. It could be any, the pandemic of the 1917s. Any day, if you left the money in there, just left it, you would have had a positive outcome. You would have had more money at the end of the period than before in something like 99% of scenarios. So you would have had to be pretty unlucky to say maybe invest the day before the crash of 29, and then 20 years later, you don't have more money. Over 15 years, it was something like 97% of the time you come out ahead. Now, if you invested the way we like to at Ellevest, which is you got a bonus at the end of the year, you got a little bit of some savings, and then do some percent out of every paycheck. What happens then? Sometimes you invest, you don't call it. So sometimes you invest on a good day for the market. Sometimes you invest on a bad day. Yay, stocks are on sale. But if you do that, I hazard to say that you would have had a positive return over 20 years, 100% of the time. Okay. So I think it's not that women are risk averse. I think it's often that we've been told somehow we think it's riskier than it's been. Investing historically with a time horizon in the double-digit number of years has not been as risky as we have perceived it to be. Now, get to the other part of your question. You said 45 minutes. That's the other problem. Is that we think it's just such a thing. And part of it, we as women have been socialized to get that A. I know everybody on this call got great grades in high school because we over-prepared, we did our homework. The problem with investing, you can go for forever. You will never know enough. And so you have to dive in. At Ellevest, I think the onboarding, every time we time it, depends on if you use you're in the private wealth business, you have a financial advisor, you're in the digital side investing, it could be 15 minutes. Choose a company that, like Ellevest, is a fiduciary that puts together for you a diversified investment portfolio that takes into account your goals, that is reasonable on the fees, and let them do the work. I think most folks on this call know if you're trying to pick stocks in there, you're doomed to underperform. That even for professionals, picking stocks is tough, can be tough going. But instead, take the 15 minutes, with an Ellevest or with someone else. Put in the information, get your money in there, and then a bit out of every paycheck, and then just don't look. Last year I barely looked. I knew if I looked, I wasn't going to like it. And the more you look, the more you're likely to make a decision out of some type of momentary emotion. But if you've got the right asset allocation or the right company putting together the right asset allocation, it's something that you should be able to almost set and forget.
Now that we know how to begin, for the individuals listening who might be Gen Z, who might be the youngest generation out there, and they have this incredible gift of time when it comes to investing, what particular advice would you give, even knowing that this generation is thinking about, well, I've got to afford my first apartment, I've got to be able to afford my work clothes, which I'm just beginning to build that out. I need to have a little bit of money to go out with friends. I don't make so much because I'm junior. What are the things for that generation to keep in mind so that they don't miss this very special window of having these long time horizons ahead?
Well, and this is where smaller amounts getting into work, power of compounding can come in over time. I remember some of the worst advice, financial advice, was my now ex-husband telling my still brother when he was in his 20s, starting out as a young lawyer, oh, don't bother to invest now because you can make so much money later. You can do it then. And just a fundamental, most of us just can't conceptualize compounding. And so the fact that, the growth rate actually accelerates and picks up and the curve gets bent is not something that comes to us easily. So it's do what you can. Obviously, if you've moved to Boston or New York or San Francisco, and the rents are outrageous, you do what you can. If you should have some fun. If you don't go out to dinner with your friends and you're sitting there all day long just with the investing dollars, that's no way to live a life. The goal and the target, I'm sure many of you heard the 50-20-30 rule, which is that 50% of your take-home pay should be for your needs, 30% should be for fun, and 20% should be for future you. And take care of her, particularly for us women, because bad news, people, or good news, I don't know, 80% of us die single. 50% of marriages end in divorce. We live 6 to 8 years longer than the men in our lives who were partnered with a man. P.S., by the way, if we outsource the money to him, when it comes back to us, 74% of us have a negative surprise. So don't do that. But recognize that you've got to take care of grandma you. And so in order, you want to pay down that credit card debt with that 20% for Grandma You, particularly with the rates so high. Otherwise, you can invest in the market, but if it's going, more of it's going out the other side from credit card debt, you're moving backwards. You want to, at work, if they have a 401k, particularly a 401k with a match, which is free money, you want to be investing there. That's those first steps of investing. You want to build an emergency fund of 3 to 6 months of take-home pay, and whatever else you've got, you want to be investing with an Ellevest or another type of company like that. 20% doesn't work because the rent's too high. I totally get it. 1%, 0.5%, 2%, just some amount that you're always socking away for future Grandma You is helpful in terms of getting you on the right track.
And the corollary question to that, because I think the middle is pretty clear to people, what should women do as they get older when they think about their investments, and how should they conceptualize if they're right about to retire in those couple of years towards it, or once they've retired? How should women who are listening or approaching that and it feels murky and hard to understand, what would you recommend?
Yeah. It's never too late to start either. Obviously, what you invest in changes and shifts as your age changes and shifts, and as the time horizon for your goals. If you want to buy a home in the next year and you're investing with, say, an Ellevest or someone else to do it, you don't want to be in 100% equity. Just like, at the age of 70, you don't want to be in 100% equity. When you're in your 20s, you can afford more risk in order to invest to get the additional return. Look, I think these are places where you can keep it pretty simple. A diversified investment portfolio, a bit out of every paycheck, low fees, fiduciary, organization that rebalances for you. So if the stock market goes way up, you're forcing yourself to sell through rebalancing and put it more in bonds if they haven't done as well, so that you're keeping that discipline. I think it's the keep it simple. If you're able to, and you've had some success and you've got some financial resources, I think it could get pretty interesting that you can begin to invest perhaps more in privates or alternatives. What I love that we're doing at Ellevest over the past couple of years is, while other folks were going for crypto, and remember, crypto was not only going to go straight up, it was also a diversifier. At Ellevest, we were investing in women. And so we took our mission and sort of took it to the nth degree and provided impact portfolios for our digital investors. And then for those investors who are ready to work with a financial advisor, investing in things like venture capital that gets more money to women startup CEOs, investing in workforce housing that's rented out to women in transition and fixed up in a sustainable way, working capital to women small business owners, some climate change that affects everybody. It affects women more. And so really beginning to layer on, once those basics are in place, the ability to also invest in themes that move us, never giving up financial, never trying to give up financial return, but looking also for an impact return for those who have got the basics in place, I think is a lot of fun.
Wonderful. We have a terrific question from Mimma Michello, who is one of our Boston Women's Workforce Council members, a real champion for women's advancement. And she's asking, what is it that employers and companies can do to help their teams build financial fluency and have a better sort of understanding on what to do and when to do it?
Yeah. Let me answer that a little bit differently. Because I think with financial fluency, there's financial education that we can provide. There are the employee benefits that we provide. One thing that I would note, this money is such a source of stress for women, and companies today continue to oftentimes center on what men's financial needs are. And so what I mean by that is that in the Ellevest Financial Wellness Survey, we surveyed thousands of folks. You ask men what their number one financial goal is, it's retirement. Got it, right? Women, that's number 4. For women, it's taking care of their families. And so as companies, the employee benefits that we tend to provide are those that we have historically provided and that have a, financial horizon that is out further. For women, that financial horizon tends to be in closer, particularly true if they are, not as wealthy. And how can you help me with my family care? Is it, starting with mandated paid parental leave, which, I don't have to tell this group again, how the US ranks when it comes to that. And it always still surprises me what a small percent of companies provide this for their employees, male, female, all genders, particularly given that it's been shown to pay for itself so quickly through reduced attrition, through increased employee loyalty. So things like that, things like, on-site childcare, if that's something that's available, through greater flexibility on the leave days that are permitted, to take care of childcare emergencies or issues that disproportionately can affect women, such as, paid safe leave, for example. And so taking a step back and asking ourselves the question of, do we think we're providing resources to all when in fact we're tilted one way or another? I mean, one example that we've seen quite a few times at Ellevest, it will talk to heads of HR and they'll say, well, we make, sort of these investing options available. And you say, well, what percent of men take it up? X percent, what percent of women take it up? X minus percent. And say, okay, so you think you're offering this for everybody, but are you? Or are you offering what's been offered in the past and it's being disproportionately taken up by men? Are you centering your services across the genders?
We have a great question from one of our listeners who says they're about 30 and they're trying to balance investing and saving some resources to purchase a home in the near term. Are there some shorter term investments or things to have in your portfolio when one knows one's going to need that money to do something important and hit that point 1 of home ownership?
Yeah. It depends on how quickly you want to buy that home, because the right answer could well be cash for you if it's coming up within the next year, say. But traditionally, that's why it's not all equities. It's equity and fixed income, and some alternatives where those are available to you to be sprinkled in, so that you get the diversification again away from the traditional equity investment. Last year it didn't work so well. There are years, the most volatile years, the correlations tend to, come together closer to 1. But in a typical year, the diversification that the fixed income can provide has been a benefit.
We're getting quite a number of questions really focused on when women are older. Our listeners are defining it as 60 plus who are in this discussion with us today. And there's 2 things that people are asking about. If you haven't begun and you're 60 plus, is there anything unique they should be keeping in mind? And how would you advise women who are making a change later than they anticipated? It might be that they're preparing for a divorce and they've been out of the workforce and they're thinking about how do they restructure the financial future, going from being part of a couple to now being single and needing to structure their finances for 1 rather than 2. Do you have any advice as people are tackling that journey? And while you're answering it, I'll also add in, as women at any age are considering moving towards a divorce and trying to prepare for their financial independence in that way, do you have anything that you would advise or tell people to think about?
Yeah. So much here. So first of all, as we're thinking about divorce, and of course, I would note today is Valentine's Day. I would also note that I actually wrote about this in our newsletter today. Bizarrely, over the past couple of weeks, I've had 2 women tell me that I was a catalyst for their divorce. And by the way, not in any weird way, but apparently, they heard me speak about how, sometimes we talk about money is power, and that, in these relationships, the men tend to, women, we're told we're not good with money. I sort of feel bad for the guys because they're told they need to be good with money. As I said in the newsletter, the 007 of money, certain and strong and, stable. And it, we in our society won't even let men ask for directions, right? So they're not allowed to say they're bad with money. Uncertain or their crypto trade went wrong. They are expected to be this sort of pillar of strength. And so women have a lot of stress from being shut out, and men have a lot of stress from having the weight of it. That's why, as mentioned earlier, when the money comes back to her, 74% of the time, there's a negative surprise because she's been socialized not to ask, and he's been socialized not to tell as well. Now, the good news here is that there's research that shows that the more often a couple talks about money, the happier they are. And that the happiest couples talk about money once a week. And it doesn't have to be, let me see your bank account and I'll show you mine. It can be as simple as talking about dreams and aspirations when it comes to money. The negative side of this, very sadly, is there is no domestic abuse without financial abuse. And so because money is such a symbol of power in relationships, if the power is shared, they tend to be happier. If the power is not, they tend to be tougher. I've talked about it broadly. I learned the lesson the hard way, even though I was a young investment banker in my 20s. I did the cooking. I did the scheduling of the social events. He took care of the money. And when I found out he was having an affair with a friend of mine, I not only had that happen, but I didn't know how much money we had. And I thought, can I trust him? If I can't trust him on that, can I trust him on this? And so my best advice is, particularly for the younger ones on the call, share that, responsibility over money early and often. For those who are at a different stage of your life, when you're moving into your 50s and your 60s, if the kids are out of the nest, you've gotten them through college, go that's 50, 30, 20 I talked about, where the 20% goes to future you. Make it 30, make it 40, make it 50. That, at a more youthful age, gosh, I can't make these ends meet, as you've moved on through life and maybe, are not going out as much. Certainly if you're me, you're not, or a different stage, socking more of that money away. The answer really is never to try to make it up through investing in higher risk investments. That can go right, but it can go wrong. And if it goes wrong, you don't have the time to make it up. The other thing I would say that's interesting through all parts of our lives is making our longevity work for us. And we do that through our investing algorithm at Ellevest, recognizing that with a longer life, you can invest a bit more long-term as well. You'll certainly need more, for those years in retirement, but you're able to invest in equities for a longer period of time to work to earn the returns.
So continuing on this generational theme, we've had a couple wonderful questions about parents. And if one is a parent, how does one juggle thinking about, do I put the dollars in the college education fund? Do I put the dollars in the retirement? Do I put the dollars maybe into tutors to get the kids into school? Do I tell my kids they're on their own? What is the right way to approach it? Or what are the things to consider to define one's own path?
This one's tough. And I grew up in a family in which there were 4 kids, age difference, oldest to youngest, 3 years and 11 months, no twins. And my parents were in their 20s. And I'll add, this was in the state of South Carolina. So they chose to make the life-altering decision for us as a family to take out loans to send us to private school. So they, could get us out of what was at the time 48th or 49th ranked public schools and into private schools. The stress on my parents in those years, was just crushing. They are madly in love still in their 80s. Crazy madly in love. But money was the only thing they fought about, and they fought about it hard. because we simply didn't have the resources. So having been the beneficiary of that type of privilege, for me to now give the pat answer, which is, and it's true, it's the mathematically correct answer, which is you got to put it in the retirement. That there, as much as, you love those little crazy kids, there are student loans. If you keep them up on their homework, there are scholarships, there are less expensive colleges to be sent to. There are other options for retirement, particularly for us as women, since 90% of us are going to manage our money on our own at some point in our lives. There ain't a lot of retirement loans or retirement scholarships. Nobody ever got a scholarship for the best retirement. And so you've got to take care of yourself. As a parent, that's a ridiculously difficult thing for me to say. The flip side of it is kids are an investment. And the other thing that may compound is education. I think about that a lot. We talked about the investing and the real estate, maybe education does as well, sort of through the generations. And so maybe the happy medium is investing in the kids and just making sure they know that, they're going to have that mother-in-law apartment that is going to need to be available to you for the whole of your retirement. We joke a lot in my family about multi-generational living when it comes time. And it's not, for me, it's not, I pretend like for my kids, it's a joke. For me, I'm not joking. I'm completely serious.
Absolutely. A number of individuals are feeling tentative about investing as we move into a period that's higher on inflation, and people may be a little queasy about what they're going to be able to afford. And additionally, wondering if we're going into recession.
You have no idea. Come on, people. You have no idea. You have no idea. Nobody knows. And whatever is known is priced into the markets. The market, the stock market is a forward-looking discounting mechanism. And so by saying, gee, I don't know if today is a right time to invest, what you are saying is, I think my intuition may be better by the 4 minutes I just took to think about it or read about it, may be better than all the other investors as a group out there. And by the way, that includes all of the portfolio managers and analysts and traders in Boston, right? All of whom have been spending, and I know them all, they all used to be my clients. They're super smart. It is their full-time job. They went to business school for this. They've been doing it for decades. If they weren't good at it, they would have gotten washed out. But their collective wisdom of all of them full-time on it, you have got it figured out. It's just not going to happen. It's just not going to happen. And P.S., the other thing I can tell you is, if you're worried about recession right in front of you, the market's already discounting it. And so one of the things we know for sure is that markets, if a recession's coming, the market recovers well before the economy recovers. And so for you to not be one step ahead of the market, but 2 steps, it's just not going to happen. That's why, just invest whatever that is in savings. If you fine, I'm perfectly happy for you to say, let me break it into 12ths and put, it in 1/12 over the next year, so that if there's a fluke of nature and today was a really bad day or good day, it doesn't, help me or hurt me the whole way through. But investing should be so boring, and you should not think about it. And the more you think about it, the more you're going to do things that maybe works one time. I had this one call, I watched CNBC, I had this one amazing call. But seriously, you're so talented that you're going to be better than the collective wisdom all the time, enough to make a difference over the course of your life. It's not going to happen. Not going to happen. The only place where, to my view, alpha is available, so returns that are in excess of and non-correlated with, let's say, the stock market, is in private investments, which is, I was talking earlier about the affordable housing or the climate change or femtech, health tech for women, things where there can be true value add that are away from the ultra efficient glare of the public markets. And by the way, do not believe those people on CNBC who are so confidently talking about what's going to happen. If you ever go back and check them, the only thing that works is they just are so damn confident. It just is very, and by the way, also remember that we find confidence so compelling, we are drawn to it. So much so that people who are overconfident and have proven themselves to be, we're still drawn to them. Think about Adam Newman, right? He destroyed billions of dollars of value, and yet he still gets funded again because that is one confident individual.
As we're nearing the end of our discussion, you've done such a beautiful job of really laying plain some of the tools, the strategies, where to get this information, how to trust. I know you've worked with so many clients and so many women. Could you share with our audience today, what do you see on the other side when it goes from stress and sort of being paralyzed to women who've invested? What is sort of the beauty that women find in their lives when they've taken this time and taken this step? What are the positive outcomes that women can look forward to by taking hold of their financial future?
Yeah. What we find is actually such a motivator for women, and I hope will be a motivator for the folks on this call, are, what's your dream? You know, what is your dream? And most of us think in order to get there, we need to go and get a raise to get the money to live the dream. Raises are non-compounding. What we need to do is put aside some of that money and get it invested. And in fact, for many women, the amount of money they lose from their gender investing gap is more than their gender pay gap. Again, because, of the compounding effect over time. P.S. I wish I could put a clock on the wall of every woman out there for if they invest, how much, or if they don't invest, how much they're losing by not investing. For some women, it can be, we've gone through the calculation, you're making $85K a year and putting aside 10%, et cetera, over a period of time, not in the first year, but after compounding's taken effect, you could be losing as much as $100 a day. Wow. Now think about it, right? If, you had a pocketbook with a hole in it and $100 fell out, when would you fix that hole? So the first day $100 falls out, do you fix it? I mean, I would, but let's say you don't, you got another $100 falls out, another $100, another, over a week, it's 700. Like, are you going to fix it or not? You would fix it, but there's no clock on our wall telling us this is how much you haven't earned, because of compounding. So I wish we could have a clock on the wall, and I wish we could say it only is going to take you 15 minutes, 20 minutes, 30 minutes up front, whatever it is. And yeah, you're going to have to deal with some volatility along the way. But if you just don't look, that's been a proven strategy. But the flip side of it, I would say, is it's how much you have lost historically by not investing, but it's how little time it can take. Because that where we all put all of our time, which is into our jobs and our careers, and how do I outperform, and how do I, switch bosses because this boss is no great, and how do I get this extra project, and how do I now ask for the raise and practice asking for the raise, and I'm leaning in, and I'm knowing my worth, and I'm confident but not too confident, and I'm assertive but not too assertive, and I'm asking for the right amount but not too much, and should I ask for more, and are they mad at me, and how much time does that take? Like your whole life, versus investing is something you do and then goes to work for you. So when people talk about getting your money to work for you, that's what they're talking about. So what do I see on the other side? Not perfection, but if you could get rid of your number one source of stress and then have your number one source of stress be your kids, as it should be, that's a pretty fair trade.
Thank you so much to both of you. Sallie, you have been absolutely wonderful and exactly what we wanted to hear today. And thank you, Victoria, for those wonderful questions. It's been a fascinating hour. In closing, I just want to remind everyone that 2023 is a data year, and we will begin training in April. And Sallie, you'll be interested in our data when it comes out, perhaps in December, about hopefully some progress made on the wage gap. We hope everyone will submit their data this year. And again, thank you for your attendance, and thank you to our wonderful guests, and have a great day.